Hey, listeners, welcome back to the ValueHunt podcast. And today I'm here with Sebastian Krog. I hope I pronounced that correctly, but if not, I'm sorry. And yeah, I'm really happy because we are going to talk everything full time private investing, microcap investing. And Sebastian is a great guy, and we've talked before, and I think it will be a very interesting conversation. So, yeah, Sebastian, why don't you say a couple of words before I ask you the first question?
Yeah, hi David. Thanks for inviting me over to your show, and it's a pleasure to be on here. And yeah, looking forward to our conversation. I'm Sebastian from Germany. I write a newsletter called Treasure Hunting, and yeah, that's what I do currently full time. Um, I write and invest in microcap stocks. So I write about microcap stock and also invest in them. So yeah, you can say I'm a microcap investor, and yeah, that's basically what I do for a living.
Nice. That's really cool. And actually, that goes in line with my first question, which is how did you become a full-time private investor? Obviously, you do the Substack and all that, but yeah, tell us what was your journey to get where you are today?
Yeah, sure. So my journey started when I was 16, I guess. That was the first time I stumbled across the stock market and basically that you can invest your money. Like the whole concept of
Hmm.
okay, you are able to actually grow your money by investing in the stock market. And in Germany, we have a relatively famous guy, I would say, if you kind
Hmm.
of get into the topic, who really is famous for investing into ETFs. So he
Okay.
he wrote a book about this whole concept that and showed a lot of statistics that actually most private investors are not able to beat the market, and that they would be better off by investing into an index fund, such as the MSCI World in that case. And maybe also some emerging markets funds. And that was basically how I started out. So
Hmm.
the approach was very, let's say, science based, which is dollar cost averaging your whatever kind of sum you have every month into the MSCI world, and say maybe another index fund. So that's how I started out when I was 17. I remember I needed to convince my parents to open a brokerage account for me because I was not 18 yet. And yeah, eventually, because during that time I also got interested in economics and in
Yeah.
entrepreneurship and starting your own business, because obviously during at that age I barely had any money left, which could have significantly made any impact if invested. So I quickly figured, okay, if I invest like $50 a month, that's not gonna cut it, right? I need to also
Hmm.
increase the amount I can invest. So I started to, yeah, did some research and kind of try to basically do some entrepreneurial projects. I mean, it started off very basic, just teaching English for other students, yeah,
Mm.
like younger
Nice.
students at my school, and eventually it evolved into selling products on Amazon, and then eventually from there involved into helping other people to sell their products on Amazon. So more
Hmm.
the marketing part of it, and then eventually involved into the founding of a marketing agency, which I founded in 2020 with a business partner. So I have been running that, or I ran that company until last year. So for 4 years, basically. And then at that point, I sold my part to my business partner. So he bought me out, and since then I'm focusing on the Substack. And since then
Hmm.
I basically do that full time, investing and writing about investing and researching companies, and that's basically my journey, kind of yeah, the essence of it, and how I got here.
Nice. Nice, that's pretty cool. I have a couple of questions on that. Obviously, the first one that comes to mind is how what lessons did you took from kind of running a marketing agency? Because obviously, probably it has nothing to do with investing, but I guess you learned something about business. So yeah, what were the key insights from that, and yeah, probably double click on that experience, I guess.
Mm, I would say, let me think. So one thing I kind of realized at a later point, because when I started the company, or we started the company, I didn't pay much attention to investing, right? So
Hmm.
I mean, I did some classes, economics classes, but I was not that knowledgeable about cash flow statements, balance sheets, etc. And one thing I later on then realized, when I even kind of got more knowledgeable about cash flow statements, is that I mean, if you run an agency, you have a very asset light business model. You don't have any
Hmm.
capex, you don't need any huge expenditure, but in most cases you feel like, okay, we have a lot of revenue, we also have a decent profit, but we barely have any cash
Yeah.
on
Yeah.
our
Yeah.
account, right? And the reason for that is basically, which I then learned, or when I kind of got more knowledgeable about cash flow statements, just that because you don't operate with a negative working capital cycle, right? So you
Yeah.
usually have to pay your employees before you get the money from your clients. So that usually leaves you in a position where you show good profits and good revenues, but your cash flow is usually, or your cash in general is usually lower than your profits, right?
Hmm.
So I guess it was one thing which I kind of learned firsthand, the importance of, if you like the working capital items and how they affect your, obviously, your cash flow at the end of the day. And even though you maybe look at the business model, which is asset light, defined as having no capex spend, if all the money is if it operates with a very positive working capital cycle, you basically end up with kind of the same issues, which is that
Hmm.
you don't
Yeah.
generate a lot of free cash flow, or at least us, if you're growing, right? If you don't grow, then
Hmm.
it's the opposite. Then
Hmm.
obviously you do generate a lot of free cash flow. But if you are growing and you operate with a positive working capital cycle, I think that's something you should be aware of as an investor. So maybe that was a very niche answer, or
Yeah, yeah.
to your
But I
question.
actually liked it. It was really cool because I actually just finished reading Financial Intelligence a couple of days ago, and the main insight from that book was that profits doesn't mean cash, right? So I guess it goes hand to hand with that, and it's pretty cool that you experience it firsthand. I guess most of us just read it in the books, and then it
Yeah,
doesn't feel like real, So yeah,
yeah,
that's
exactly.
pretty cool.
Yeah.
Nice. And now the other question I had for you
Mhm.
is actually, I think many people know the benefits of being, I guess, self-employed or full-time private investor. You have the independence and all that, but I'm curious to know what do you think are the downsides, or like the bad part about being, yeah, self-employed and full-time investing, I guess.
Yeah, let me maybe rephrase your question or answer it more
Hmm.
broadly to being self-employed in general,
Yeah.
because I've been self-employed for, yeah, basically my whole adult life. So I think I
Yeah.
can speak more to that topic than being a private investor, which is probably
Hmm.
very similar. I mean, you don't have a
Hmm.
boss at the end of the day. And
Hmm.
yeah, I don't think on paper, objectively speaking, that the benefits outweighs the negatives. I think it's a
Hmm.
very personal decision. I
Yeah.
would never recommend anybody to become self-employed, and I would never recommend probably anybody to kind of, yeah, then being maybe a private investor, or kind of,
Hmm.
don't do not have a regular job, right?
Yeah.
Um, because it's just so off the beaten path, or it's so different from what like 99% of all the people do, that I think you
Hmm.
really have to be the kind of guy for that. And if you are
Yeah.
the kind of guy for that, then you don't need to hear any kind of advice, or any article, or any kind of opinion how good or bad it is, right? Because there's no other option for you. I mean, most people
Hmm.
I know who maybe are self-employed or running a company, or maybe are even private investors, they're just not capable. They are not suited for having a normal office job, right? Maybe they had one for
Hmm.
1 year, 2 years, 3 years, and they absolutely hated it. So there's just no other opinion, no other
Yeah.
option. Sorry, there's no other option for people like me, I guess. So it's not a topic where you go, okay, what are the benefits or the negatives? It's just like, okay, there's no other option. That's the only way to go. And
Yeah.
I to answer your question, I think it's like, if you really want to do it and you know you really want to do it, then you just gotta do it. And obviously there are
Mm.
negatives that come with it, but for me, and kind of my personality, um, at least right now, being like running the Substack, I don't. For me personally, there are no real negatives,
Hmm.
or they're at least so small that I barely recognize them or see them as a
Yeah.
negative. I think the most important thing is that you just do something that you love or that you really like to do,
Yeah.
because
Yeah.
it increases the likelihood that you spend more time on it, which therefore
Mm.
increases the likelihood that you get really good at this, which
Yeah.
therefore basically is a reinforcing feedback loop, because if you get good at something, you will always get more pleasure from it, so you will actually even like it more, right? So I
Hmm.
think this doesn't matter if you maybe in a job or being self-employed. I think that's the um, most important thing you can you can do in your entire life, in my opinion.
Nice. That reminds me of one of your recent posts, because I mean, I don't know if it's recent or not, but you talked about correlation and causation when it comes to insider ownership, and I guess you just described how kind of liking something correlates to having success on it, not because liking it makes you successful, but because you spend more time and so on. So probably a good segue would be to kind of pivot into that, like what did you found out by studying studies on insider ownership that probably most people kind of just assume right away something that it's good or bad. So yeah, probably expand on that.
Yeah, sure. So in the article I published, I basically wanted to write an article for a long time about some something that people think is very important in investing, but is actually not that important. And eventually,
Hmm.
I came to the kind of conclusion, okay, insider ownership is the perfect example, because I
Hmm.
do think that, but it's not only investing, and I made also this kind of comparison. It's in every subject, right? I mean, I
Yeah,
took
yeah.
the example of sugar, because if you see people maybe that try to lose weight, they can come up with other kind of fancy diets, but at the end of the day, the diet itself does not matter, right? It's only about
Hmm.
being in a caloric deficit, that
Yeah.
that it's the most important, right? And there are many potential correlation which could lead to that outcome. So in investing, you usually, one thing you really see in a lot of pitches or a lot of investor paying attention is, okay, how much does management own, right? Oh, they
Yeah.
own like 10%, 30%, so they are aligned with shareholders. But if you actually look at a lot of data around this, and for the data part, I basically asked Ryan, which is he's a quant. He's also on Twitter. He's a great guy, and he provided me with some data around that, so I could basically prove my point with science. And there's basically just no there's even no correlation between that. I mean,
Hmm.
from a point of causation, it's basically not there. Like
Hmm.
I mean, you cannot make a argument that the cause for outperformance was because the management owned 30%. Because
Right, right.
what really causes outperformance is not that they own 30%, but that the management executed well.
Yeah.
So I just think it's something that maybe is has basically neither correlation nor causation with outperformance, because you really want to focus on the real correlation or real causation, which again is that management performs. And I've seen a lot of management perform very badly with 30%, with 40% ownership, and I've
Yeah.
seen a lot of management perform excellent with 1% or 0% ownership. Because in a
Hmm.
lot of cases, the ownership basically is there because they are, for example, the founder. They were there when the company got public. So they got a huge stake in a company. That does not mean that they are good operators or they're in line. A lot of cases I found actually that, for example, family owned businesses, that they don't really care about the share price despite
Yeah.
being involved or a huge owner. And the opposite, I've also found that when, for example, a new management comes on board, which naturally barely owns any stock because they came into the company when it was well public, and a lot of cases, those are not rich people. They don't buy with their own net worth, I don't know, say 5% of the company, and so they initially own very little to nothing, and they are just and the new CEO came along, and a lot of times they even perform better than the ones that have been there for like 15 years and own like 15 or 20% of the company.
Yeah. And I think there's also like this big dissonance between what kind of late Warren Buffett preaches and what actually works in microcaps, And so I would like you to comment on the quote that Warren Buffett famously said, that turnarounds seldom turn. And so, yeah, probably I think that's another interesting thing, because when I tell my friends that kind of invest in bigger caps and all that I'm investing in a turnaround, they say like, turnaround seldom turn. And so, yeah, probably just give us your thoughts on that.
I think that turnarounds, or the likelihood that the turnaround turns, is definitely increases if you have new management on board. So if you
Hmm.
have because look, the in microcaps we barely have any IPOs, right? So the most
Yeah.
microcaps you look at are basically companies that maybe have been bigger in the past, and then management or the industry, or for whatever kind of reasons, there can be multiple reasons, end up earning less money and becoming a microcap, right?
Yeah.
Or always maybe have been a microcap, so never really took off. So in order to be in that situation, you usually are not a good company. And if you invest in those companies, you're basically betting on, obviously, that they get better, right? So I would say most companies or most microcaps are in somewhat kind of a turnaround, because you barely invest in the IPO that got public 2 years ago, has beautiful financial, and is growing since the company was founded. Because then, like, it wouldn't be a microcap, because you don't get those IPOs at such a low valuation and such a low market cap.
Yeah.
Mm, so if you're a microcap investor, you really have to learn naturally, therefore, how to spot or maybe how to evaluate the turnaround, and how successful you think it could be, right? And I've just found that in a lot of cases, if a new management comes along, and they substantially change the course of the business, the capital allocation strategy, that it's basically like a new company they're
Yeah.
building, obviously on top of the foundation of the old company that the old management left behind. But you really have a lot of yeah, just I mean, you have new people running the ship, you have a new strategy how to allocate the capital, you have maybe a new strategy on which segment to focus on, and all that stuff. So there's really not a lot of overlap with the old company. And also, what we have to keep in mind, and that's maybe also learning I learned from running the agency, because a
Hmm.
lot of people used to tell me, so like, for example, during COVID or during other times, like they asked me, okay, so the the industry is not doing well right now, like nobody spends money, like do you have any impacts, do you feel any impacts of that? And I always responded, look, we are so small, like the impact if I do more work or if I do a better job is way higher than how the industry does, because we are such a
Yeah,
small
exactly.
company. And
Hmm.
I think it's the same for microcaps as well, even though they are obviously a bit bigger than my company, but still most of the companies are so small that it's very easier to turn. It's way easier to reinvent the company and to
Exactly.
change the direction of the business. And so, yeah, to answer your question, I think that microcaps are probably the one category where turnaround is more likely to be successful, in my opinion, especially paired if, with a new management.
Yeah, and probably a business that's not dying completely. So yeah, I think that was a great answer. Yeah, so as we've seen, your investment style is kind of unique, I guess, compared to the broader common sense on like what investing should be like. So I guess my question would be, what are some unusual traits or something unique about your investment approach that's probably 99% of the people don't do?
Yeah, I mean, if you're investor in micro caps, then by definition you're probably kind of unique or strange compared
Hmm.
to the overall market, because most money obviously is in the larger cap stocks or in the indexes and indices. So yeah, I mean, if you invest in microcaps, you are definitely um, playing a lonely game, and that usually involves doing a lot of work completely alone, not relying on any analysts and consents. And yeah, so just be by being a microcap investor, you are probably kind of unique. If you then also go to the microcaps, which are maybe even are not that known among microcaps investors, then it gets really lonely, right? So I would say the the biggest kind of uniqueness or differentiation, I believe one can have with if he trades with a small sum of money,
Yeah.
is the companies you look at, right? Because
Hmm.
like I don't do any crazy analysis, any crazy, I don't know, like complicated thesis. Those are usually very straightforward, simple theses that most people would probably agree on if they would look
Hmm.
at the company. The difference
Yeah.
you make if you operate with a very small sum of money is to look at companies that most people don't even look at. So we are talking about maybe companies below 50 million, below sometimes 30 million market cap, like very small companies that do have a history of decent operations, maybe even. But for some reason, maybe they had some issues, or maybe they're just so they don't file with the SEC, for example, or there can be like multiple reasons why the stock is just not discovered at all. And
Hmm.
so I would say that the biggest differentiation you can do is just make sure to not compete against smart money or like most people. And I remember there's a nice blog called No Name Stocks by
Okay.
Dan Shum, I guess is his name, and he's one of the best private investors I think out there, because his track record goes for I think more than 10 years, and he averaged 30%
Hmm.
CAGR in that time
That's
period.
cool.
And he's not even full time investor, like he does that um, besides his main job. And yeah, he once said that he doesn't want to be the smartest in the room. He wants to be in a room where no one else is. So, and I think that that's a very good analogy for investing with a small sum of money. You really want to be where basically no one else is.
Yeah, I think that really kind of boils down the whole idea of microcap investing. So yeah, great quote, I guess. It was fun. Um, Another thing that I learned through you, I guess I refined through your posts and by reading what you post, is the idea generation process, because I think you were one of the only ones that could actually give a pretty objective and practical explanation of how you generate ideas. Obviously, it's more art and science, and not all ideas come in the same way. But could you probably describe to my audience what that process looks like, and how do you keep track of those ideas? Because I feel like that's an important part of your whole strategy, right?
Yeah, exactly. That has also evolved in the last year, and is obviously also a consequence of the fact that there are not as many new companies, right? So usually,
Hmm.
if you talk to an experienced investor who has maybe, yeah, invested in microcaps for 10, 15 years, you usually cannot pitch him a new idea. It's usually an old
Yeah.
idea that now has new legs, right? So, like, just from a very objective practical point of view, I would say the probably the best way to generate new ideas is pick any stock exchange you would like to get to know, or any kind of market, any kind of country, right? So I don't know, let's just say the USA as an example, and then you just look at yeah, most or all of the companies you can look at that are trading below, say, 100 million market cap, right? And maybe you take out like some very, very, very basic filter. I don't know, like they should have revenue, right? Maybe they should not have more than, say, 100 million shares outstanding, because usually as a kind of heuristic, companies with more than 100 million shares outstanding are usually very dilutive, usually are not
Mhm.
that high of quality. So by just cutting them out and cutting companies, pre-revenue companies out, you already
Yeah.
kind of cut out most of the trash. So then
Yeah.
you come up with a list of the other remaining company, which is still a very broad list. And then you just go through them and you just put them on your watch list, right? There are different ways to get notifications when they file something. There are different tools for that. If they file with the SECs, there are tools, um, even more tools, which are tracking well, if a new SEC filing comes out, most companies, if you don't want any tools, have investor relation email newsletters where you can put yourself in, or they file their
Yeah.
press releases with global newswire, so you can also get a notification there if you sign up for that. So basically the whole exercise would be to come up with a list of, say, 100, 200, 300 potential investable companies. So companies, again,
Mhm.
that maybe operate in a segment where you feel comfortable investing in. Maybe they again show profits or show revenue or whatever. They look like investable companies, and you just follow them. So you just put them all into your watch list. You put them all into your RSS feed, where you get the notification if they file with the SEC, or you subscribe to all their newsletter, their IR newsletter, press releases, and then you kind of, I sometimes say, then you have your investable universe, and then you wait until they find you, right? So what I mean
Mhm.
by this is, you just sit and wait basically, and see, okay, a new press release comes. I mean, you obviously do some work in front of those companies, but the goal wouldn't be to directly invest into them, but just to, like, build this watch list of companies that could
Yeah.
be investable. And then you just sit and wait, and they will file press releases, they will file their 10Ks, their 10Qs, and yeah, you just observe, and eventually someday something will happen where you see, oh, okay, that looks interesting, and then
Mhm.
you can dig deeper into this. And a lot of times nowadays, I I barely invest into a company like the same day or the same week I found the company. Usually, it is like I described to you, that it comes onto the watch list. I follow the company. There's something I like, and then maybe the next quarter comes on, and they keep on performing, or whatever kind of like major tracking events are happening or not happening, which then
Hmm.
leads me to closer to the decision of either to buy or not to buy the shares. And yeah, so kind of to answer your question, there are obviously a lot of ways to discover new ideas, but the longer you do that, I think the less important or less possible it is to discover new ideas, but rather to follow as many companies as you can,
Yeah.
to get old ideas with new thesis, with new changes, with that are now more interested than they have maybe been in the last couple of years.
Cool. So, like, I have a very simple follow up. What tools exactly do you use? I know probably the OTC like website or something, but like, what do you think are the most useful ones for like someone in the audience that wants to kind of model your way of doing things?
Yeah, if you look a lot in at American companies and they file with the SEC, there's a called Feeder, which is basically just an RSS feed. So they have a
Hmm.
native integration with the SEC. So you can just put
Hmm.
in a stock there, and you get automatically a news notification if they file with the SEC. Hmm. What else? I mean, so there are other tools which like a friend of mine who I think you also know, he's kind of working
Hmm.
on a tool, so I got the beta test access to that. So I think I cannot talk about this, but maybe it will or eventually will come out. But even
I'm
before
waiting
that,
for the beta too.
sorry.
I'm waiting for him to give me the beta test too.
Yeah, yeah. um, and yeah, apart from that, as I said, FIDA I like. Then Global Newswire, um, you can subscribe to the news alerts. Most companies do have a newsletter, and for example, if you look at Canadian stocks, you can also get the alerts if they issue a press release with the Toronto Stock Exchange. So
Mm,
yeah, there are usually easy ways to subscribe to the emails to get them, and
cool.
yeah, that would be kind of the approach I'm using.
Okay, so now double clicking on what you actually look for. So let's see you see a new press release from a company you have followed and you thought it was interesting. What kind of catches your attention, or maybe a signal for like a transformation or yeah, an interesting event?
Yeah. I mean, at the end of the day, it's always about growth in earnings per share, right? That's the
Hmm.
one metric that should need or should improve, and that's what drives ultimately the share price.
Yeah.
So obviously you can then say, okay, maybe it's more free cash flows, but usually you start with EPS and then kind of do your own calculation how much that converts into free cash flow. So just
Yeah.
as a metrics to track, it's definitely EPS. So usually you just look at any kind of events that you assume would lead to higher earnings per share in the next years. So what
Hmm.
can that be? That can come in multiple variations. I mean, that can come in uh, a new contract that has been won, right? That can come into a new product that comes to the market, which maybe has a bigger potential than the current products. That can come into maybe shutting down an unprofitable segment and focusing on the segment which is profitable. um, yeah, I would say those are probably the most usual suspects for
Mm,
increasing EPS. And
nice.
yeah, those are usually the most common catalysts, I would say.
Cool, cool. Now, switching a bit gears, I have a more practical and selfish question because now I kind of dropped out of mechanical engineering, so I have it's not a gap year, but yeah, it's I'm waiting for me to get in this other course, and so I have a bit more time to research into companies and all that. and obviously I get more ideas because the more rocks you turn, I guess the more interesting things you may get. So I'm facing this kind of dilemma between optimizing my portfolio for the best opportunity cost, like the best IRR and so on, like risk reward and so on, but also I think there's some point where there's marginal returns or like diminishing returns of the increased kind of turnover, because if you don't let your companies or your winners run, at least give them some time, and you constantly kind of switch to better opportunities, you'll just incur a lot of fees and yeah, frictional costs, I guess. So how do you deal with these kind of situations? And I don't know if in the past this ever happened to you when you became full time, but yeah.
So you mean kind of to decide when to sell a position you hold to buy a new one, and
Yeah, it's like, for example, you are fully invested, right? So you have no cash left,
Mhm.
and you find something that looks really interesting and probably a bit like more interesting than what you already have or some of your position. So how do you decide if you sell one of your positions to buy the other one, or like you just kind of sit there and yeah,
Got it.
hold
Okay.
for more? Yeah.
So usually I um I'm constantly assessing my portfolio, right?
Hmm.
So, and in most cases I already know which ideas are the weakest if
Yeah, yeah,
everything stays the same. So, and a lot of times, I just yeah, those are kind of the weakest position I have, where I expect the lowest IRR, and those are the ones that then I'm willing to sell, right, for a new position
yeah.
where I'm confident that the opportunity set is better than within my weakest ideas. So, you know
Hmm.
so that puts me into a position where I don't really have to think that much what to sell, what not to sell, because I already have them in my mind, and
Yeah,
as soon as I find something more attractive, I would sell them. The other case is obviously then if you have any change, right? I mean, selling on valuation is always tough, so I think selling
yeah,
mm, your best winners because they got a bit expensive. I think that's a very, very tough call, in my opinion, because
yeah,
usually you are also suffering from anchoring bias, right? You bought the stock maybe at a PE of 5 and now it trades at a PE of 12. But
yeah,
12, is it a fair multiple? Maybe the company also improved, which was the reason why it went from a PE of 5 to a PE of 12. So
yeah, yeah.
should you sell at a PE of 12? Maybe, I don't know. Obviously it depends, right? That's always the
Hmm.
answer. But I think it's a very tough case to decide just to sell on terms of multiples. So I am a fan of
Hmm.
letting Uranus run, as long
Hmm.
as the multiple doesn't get too crazy. And yeah, other than that, obviously, always assessed which are the weakest ideas, and those are the ones that you will then sell if you find something more attractive. But I think
Hmm.
the whole yeah, the whole topic of selling and yeah, especially selling and maybe replacing a stock is probably harder than the buying part, um,
Hmm.
especially if you which is kind of counterintuitive, but especially if you have been successful, which means that maybe you
Hmm.
sit on a couple of positions that are yeah, maybe that have doubled, or maybe that had a good return in the last years. Um, so yeah, I think that that's very difficult to assess then which ones to sell, because usually the companies have done something right, and in some cases they continue to do something right, and in other cases
Hmm.
maybe it was just a blip and it was maybe a handful of quarters, and that was kind of the peak, right? And then
Hmm.
you will be mad at yourself if you didn't sell then. So I think it takes a lot of
Yeah.
analysis and obviously knowledge about your shares and your companies that you own.
Hmm.
But yeah, I think
Yeah.
it's a complicated topic, but as long as you always assess your portfolio and kind of are always aware which are now the weakest links in a portfolio. I think you've done a lot of upfront work, which then helps you to sell them if you want to buy something new.
Got it. And do you usually keep any kind of cash cushion, or do you are you fully invested at all times?
Well, I try to be always fully invested.
Hmm.
Fortunately, I'm in a great situation that I still have inflows into my portfolio,
Oh
so
yeah.
that automatically always creates a cash cushion, right? I don't need to
Hmm.
usually sell positions to buy a new one, even though I do that. If I don't have any spare cash left, or if I don't uh, really, if I don't like the position anymore. But for now, I still have inflows, which obviously makes this whole topic then again completely different for me than for someone who maybe doesn't have any inflows and kind of has almost like a closed fund situation where you really do need to sell a position to buy a new one. So yeah,
Yeah.
those are obviously also kind of really personal, yeah, topics, or really
Hmm.
subjective and individual situations, which
Yeah.
makes it very difficult to give objective or advice for everyone in terms of selling our portfolio construction in general, because it's so subjective and so personal, this whole subject.
Yeah. Yeah, I stand more towards the closed end fund type thing. So yeah, I feel yeah, it's a bit different than when I had more inflows and all that. So,
Yep.
but also I guess it also makes you a bit more rational, because if you want to buy a new idea, you really have to kind
Yep.
of yeah, let go of something, because
Yep.
otherwise you can't really buy it. So yeah, I
Yeah,
think it's interesting.
100%. Yeah, no, I
Cool.
agree with you. Having too much cash could decrease the quality of your assessment, because you maybe feel the pressure of having 10% in cash, so you desperately look for a new idea and then think the idea is maybe
Mhm.
better than it really is, just because you want to get rid of the cash.
Yeah, yeah, exactly. Yeah, I think that's quite interesting. And like also on this topic of selling, you mentioned like not selling because purely on valuation, unless it gets stupid. But for example, innovative food holdings, I guess one of your biggest winners last year and this year, yeah, it has gone up quite a lot. So in which situations would you kind of trigger a sale, even though if it's not like related to valuation? Like what would have to happen in the business or something different that would make you, yeah, sell a position, especially one of that size, so I guess
Mhm.
you have to realize a lot of gains.
Mhm. I mean, innovative food holding is really a special situation, and I think I didn't really realize how special the situation was until
Hmm.
a couple of months ago. So when I
Hmm.
already bought all my shares, because it's really rare to find a management team as good as they are in such a small
Hmm.
company, which
Yeah.
is also combined. Then it's not only management team but also the board members, right? With Papas and Graham, you have two
Hmm.
very experienced value investors. Graham wrote the book Dear Chairman, so
Hmm.
he's a well-known public figure in terms of running activist campaigns. And Papas actually has a background in the food industry, so his
Hmm.
families do own, I think, restaurants, um, which makes this a very unique situation, because you have not only this highly overqualified management team, which already
Hmm.
is well is very good on the operational front, but you also have
Yeah.
this board members which are excellent investors, and which probably also help the management team to communicate in the right way with the shareholders. I think you really see that in the company in terms of how they communicate with the shareholders and with outside investors, how they present themselves. It's really well done. It's exceptional.
Hmm.
So in a case like this, it is I mean, look, the stock obviously now is has been running very well. We are now at I think 100 million market cap in terms of valuation. So it's definitely a point where you say, okay, it's not that cheap anymore, right?
Hmm.
But you should not underestimate their ability to also increase earnings in the next years. Because, for
Yeah.
example, they when I invested into the company, they they basically, well, the first step of his plan was to shut down the unprofitable e-commerce segment and to focus on
Yeah.
their B2B broadline distributor segment. But in the meantime, or half a year later, they basically created a multi-million dollar segment out of thin air, which is
Hmm.
supplying retail stores with cheese. So
Hmm.
we do know
Okay.
that it will probably make them multiple millions this year, and there's the possibility also to maybe not only supply retail chains with cheese, but maybe also airlines, or maybe instead of cheese, you also take salmon or um, other kind
Yeah.
of perishable items. So what I want to say is that sure, if you look at maybe the earnings from last year, last fiscal year, the stock looks super expensive. Uh, but if you really know the management team and their track record, which they already have proven in a relatively short period running the business, you kind of come to the conclusion, okay, it's probably more likely than not that they will
Hmm.
come up with something, right? That they
Yeah.
will
Yeah.
come
Yeah.
up with a substantial way to increase EPS. And I mean, they stated themselves that the first goal is obviously to get to 100 million and 10 million EBITDA, which
Hmm.
I think is probably not that far away. And ultimately, the goal is to if I'm not mistaken, create a $1 billion company, right? So they are
Hmm.
not there to, I don't know, to just say grow by 2% a year from here on, right? They're really they have an ambitious plan, and I would not bet against them. And
Hmm.
unless, say, the management leaves tomorrow, which would probably cause me to sell the shares immediately,
Yeah.
I th- I would be, let's say, less strict on valuation, because I
Hmm.
just know that it's more likely than not that they will come up with something. They will be
Hmm.
able to increase earnings per share, and that you will be fine, like in the long run. And that it's really, really extremely rare and difficult to find um, a management team of that caliber and that quality. And it is still rare to find a better situation, or a better, yeah, better opportunity to invest your money than into them, in my personal opinion. So yeah, to answer your question, probably unless management leaves, which I don't think
Hmm.
they will. um, Maybe I would trim if the valuation really gets completely absurd. But yeah,
Hmm.
it's one of those rare situations where I'm really, really, really comfortable in being my biggest position.
Mm, cool, cool. And to that point, like, how do you size these things? Like, I think that's also a very sensible topic because obviously it depends on everyone. So yeah, how do you think about position sizing in general?
Yeah. I mean, position sizing also gets more importance the bigger the portfolio gets, because
Uh huh.
obviously I mean, one thing is the percentage of the position, but the other thing is the dollar amount, right?
Yeah, yeah.
So if your portfolio gets bigger, a 10% position is not like, I don't know, it's substantially more money than it has been,
Hmm.
like, say, 3 years ago, when a 10%
Yeah, yeah.
position was way less money. um and then obviously you come into a situation where like, if you still have inflows, are substantially smaller than they have been, right? Because let's say you earn X amount of salary, usually your salary at one point doesn't keep track with the growth of your portfolio. So now that obviously I had a good year last year, so obviously the portfolio is now substantially bigger than it was 1 year ago. The whole topic of position sizing for me obviously gets a bit more sensitive, maybe so to speak, because just
Mm-hmm.
the overall dollar amount on a 10% position is now higher than it has been. So for now, my approach to position sizing usually is that I build a position which can, I mean, depending on the situation, right? There are some cases where I really take like a small position, say 1-2%, because it's more of
Yeah.
a maybe it's a situation
Tracking,
where
I
I
guess.
just like to be involved, but I don't have any high conviction because maybe it has a lot of risk or whatever. Can be
Mm-hmm.
so a lot of
Yeah.
cases. Um, but other than those very small positions, I would say the usual position size at cost is somewhere between 5 to 10%, and that's the position size at cost where I feel comfortable. And from there on, I just let the stock find its own position size by either
Mm-hmm.
management executing and share price increasing. So therefore, you obviously end up with a higher position size. But I think it kind of deserved that higher percentage of your portfolio, right? And in the other case, it obviously can also work in the other direction, right? Then
Yeah.
you
Yeah.
end up
Yeah.
with a smaller position, which also has been deserved. So
Yeah.
in a lot of cases, I'm somewhere between those 5 to 10% positions, and then take the market and the share price, take it from there. Obviously, if the situation improves, I will add. I have no issues. I love to add at a higher share price, because usually it
Mm-hmm.
means that the management team has been executing. So
Mm-hmm.
I really like to do that. Especially again, if the situation improves, I have no issues paying 20% more than my initial buy price if I think this overall situation is more attractive right now.
Mm-hmm.
On the other hand, adding shares if you are at a loss, um, or if you are down on your investment, should probably can also work totally fine, but I think you should be careful and very sure of your assessment, because you're kind of betting against the market. So you think, okay, the the decrease in share price is not justified, and that
Mm-hmm.
your opinion is correct, and the market currently is overestimating something, and therefore is wrong, which again can totally work. I just would be yeah, a bit cautious probably for my
Mm-hmm.
personal point of view.
Cool, cool. And now that we are getting into the end of the conversation, I would like to ask you a bit of question on your future, I guess. So, like, would you ever be willing to launch a fund, or what does the future hold for you? I guess.
Well, I don't know about that. Let's see. I don't have any concrete plans. The only
Mm-hmm.
thing I'm sure of as of right now is that I love to invest. I also really like to write about it, so I really enjoy running the Substack, especially now that
Yeah.
more paid subscribers are there. You kind of also get a nice community with people who are commenting, who also point out maybe some additional information because they know the company, or they ask you something which you maybe have not thought about. So you do some more research at that point. So I really like that. So honestly, right now, I would just love to continue to do what I'm doing right now for the rest of my life. And if that eventually transforms into running a fund instead of a Substack, maybe potentially, maybe not. I don't know. I don't have a strong opinion on that yet. So yeah, the only goal is to continue to do the work every day, to research companies every day, and in some way or form share that with other people, right? Whether
Mm.
that's through Substack or maybe through other yeah other channels. The future will hold that. But I really like this combination of doing my research and then writing about it or sharing it with other people.
Cool, cool. And let's do this thought experiment. So let's say you kind of have to reset all your knowledge on microcap investing and all that. So what kind of would be three resources you would immediately suggest yourself to kind of read or like absorb, I guess.
Microcap Club, number one
Mm-hmm.
for sure. Mm, well, I know nothing, right? So literally zero.
You only have the suggestions from current Sebastian, and you have to give them to like newbie Sebastian.
Yeah, yeah. But no, I mean, like I know nothing about investing, so I really start from
Yeah, exactly.
like reading. Okay,
Yeah.
okay. Okay, microcaps club still, but I mean, probably you should read like some. I really enjoyed actually One Up on Wall Street when I got
Mm-hmm.
into investing. I think it's an excellent book if you start out. So if you're really at zero, I would say Microcap Club, One Up on Wall Street by Peter Lynch. Brilliant book. And let's see, what else do we have? And focus compounding. I would
Mm-hmm.
probably either read the compilation, sorry, or just all of the podcasts, depending
Okay.
on if you prefer to read or
Yeah,
listen.
yeah,
So yeah, I would
yeah,
say those are very three very good
yeah.
resources. Maybe start with the Peter Lynch book to get hooked on investing, and then subscribe to Microcap Club and watch every video of focused compounding. Yeah, that's basically how I learned investing.
Nice. Yeah, it's I guess the compilation of focused compounding is basically a Bible.
Yeah,
You can I have yet to read everything, but I'm on my way, I guess.
yeah. No, I think
Yeah. So
the
yeah.
the thing I really like about the focused compounding stuff is that, um, say if you're researching a stock and you, I don't know, come across whatever kind of topic, right? Maybe
Hmm.
working capital and the turnover of their inventory. You can, in a lot of cases, just look for, say, inventory turnover in focus compounding and find an article about it. So I think that's really great.
Yeah, those guys did a great job. Actually, compiling everything must be
Yeah,
very, very strenuous work, I guess.
yeah,
But yeah, wonderful conversation. I hope you liked it too. So probably just tell my viewers where they can find you and yeah, your Substack. Obviously, I will link it down below. So probably just where can people reach out to you?
yeah. Sure. I'm on Twitter at Sebastian. My handle is at Seb Krog, so
Mhm.
SEBKROG. And on my Substack is called Treasure Hunting. So you find some free articles. The pitches are behind the paywall, but there are older pitches like innovative food holdings, so are completely free,
Mhm.
which are completely free, and also some general articles which are also free. So feel free to check that out.
Nice, cool. Yeah, thank you so much, and hope to chat soon.
Yeah, thanks for having me there.